BlackRock has lost $1.7 trillion in 6 months. VC funding is down, or Amazon acquires One Medical for $3.9 billion. Which one do we want to go to next? Anybody have a favorite here? Sachs, you've been a little quiet. You got one you want to go to?
We can talk about the BlackRock thing.
This is the largest amount of money lost by a single firm over a 6-month period in history. BlackRock is the world's largest asset manager, and it was the first firm to break $10 trillion in AUM, assets under management. Now, right now, they're at $8.4 trillion. 2022 ranks as the worst start in 50 years for both stocks and bonds. Chairman and Chief Executive Officer Larry Fink said on his earnings call at the end of June, only about a quarter of its assets were actively managed to beat a benchmark rather than track it seamlessly, as passive strategies are designed to do. The firm's passive equity holdings are now 10 times larger than its active holdings, although it does operate some active multi-asset and alternative strategies that narrow the gap. Collapse in bond markets this year has shaken money out of active fixed income funds.
Listen, I think there's less than meets the eye here with this. I think this was a headline that was trying to grab attention by saying biggest loss ever. Look, the reason why it was the biggest loss ever is because BlackRock is so big. I mean, and what is BlackRock? It's basically at this point, they're index funds. They're ETFs, they're index funds. Yeah. They just represent market indices. So, you know, the reason why it went down 1.7 trillion is because it started with 10 trillion. Yes. So the average index is down 17%. That's all it means. We know this. The S&P 500 is down 20%, 22% for the year. The Dow Jones down 15-ish. The NASDAQ is down like 30. So this is just reflecting what we already know, which is that the stock market is down this year.
Do you think it's another data point to support the idea that active managers, generally speaking, and maybe holistically speaking over time, cannot beat the the market, cannot beat indices? I mean, do you have a point of view on that as an investor, Sachs?
Well, I think, you're talking about public market investors. I think it's very hard to beat. I think it's very hard to beat the public markets over a long period of time consistently. I just think it is. Now, the contradiction, though, is that if you have no active managers, then the indices won't be efficient anymore. So you need the participation of the active managers to help drive the indices and make corrections to it. So, and the fewer active strategies you have, the more inefficient the markets will become, thereby inviting active strategies. So, I think it's a good question. I think there are some managers who can probably do it, but I think it's a very tough thing to do.
Chamath, what do you think? You're a public investor, active selector of investments.
I've been thinking a lot about this. I think that I have disproportionately benefited from being at the right place at the right time, backed by enormous amounts of central bank money. And so I think we all have been. I think it is very difficult to be a public market individual stock picker in a world where the central banks are constantly meddling. Because when they do, the best thing that you can do is belong the market beta. And the more concentrated you are, the better returns you would have delivered since 2008, when the central banks started to get very aggressively involved. When individual stock pickers reigned the universe was when central banks were largely on the sidelines. And so there was all kinds of dispersion, right? Dispersion, meaning good outcomes, bad outcomes, lots of alpha, right? Meaning your performance was independent of the market. But since 2008, it's largely been beta that's driven the market. And the folks that have done exceedingly well were those in tech because we delivered the best beta. And every time we confuse alpha and beta, we get over our ski tips and there's always some big blow up. So I think my general takeaway is that if the central banks stay on the sidelines, individual stock picking reigns and active management can win. If they continue to be involved and do quantitative easing and all of this other stuff, index funds that are long concentrated market beta will always outperform in the long run.
I was watching Warren Buffett answer some questions, and one of the questions, and this goes to the law of big numbers like BlackRock, he was saying, listen, the reason I did better earlier in my career than later in my career on a percentage basis is because I had a smaller amount of capital and I was placing it on smaller bets, smaller ideas and themes. And then as I had a bigger chip stack, I had to find bigger ideas to put more money to work. And therefore, more people were looking at those. And so those assets were not undervalued. And so I found that very insightful in terms of when you participate in the market. If you're trying to pick between very large bets like Cotu and TPG and Tiger were doing in the growth space stacks, like now everybody knows that these companies, everybody knows Stripe's a winner. Everybody knew Airbnb and Uber were winners, in the late stage of the private. Everybody knew Facebook was a winner in the late stage private market. If you're battling that out, Yuri Milner is going to come over the top and pay $2 billion more than you, or Masayoshi-san's going to pay $5 or $10 billion more than you. Where is the alpha there? Where is the gain?
The alpha's in the fees.
Okay, there you go. And so they were playing a different game. And I started trading this past 2 weeks because I've never traded public stocks and I wanted to add it as a skill set. So I put a couple $1 million into an account, and I'm just trying to actively figure out how does value work there. And, I'm just starting to make trades that I want to hold for 10 or 20 years. And we'll see if I can beat the market. That's the other thing is, what do you want to spend your life doing? If you can put money in a passive index and not do any work, well, that's attractive as well. So Sachs, what do you think in terms of active management, in these public markets and the size of the bets that have to be
made?
I
said, I think it's very hard to beat the market consistently. I think it's a very tough profession. I'm sure there are people who can do it, but I don't know if it's easy to predict who those people are. So look, I think it's something that can be done, but I just think it's a tough game. I mean, what we do as private investors is a little different, right? Because not everybody is in a position to buy shares, right?
Yeah, you're not available to you. You don't even know the company.
Access is limited and information is limited. And in exchange for that sort of preferential access that we get, we actually have to do work.
So when
you're a public investor in a company, Disney or whatever, you don't do any work. You're not involved at all. We do a lot of work for the companies, and that's why they choose us. And so it's not, you're not competing against the whole world. I think the public markets are just so competitive.